This is Al Brooks, and this is my price action trading course. This module is entitled How to Trade. As a trader, you have to have goals. For me, my number one goal is to follow my rules. My next most important goal is not to lose money. To me, that's far more important than making money. I want to make sure that I'm doing the right thing and that I do not lose money except when I'm doing the right thing. I certainly don't want to do things that will cause me to lose money. Next, I want to make money. Obviously, everyone wants to make money as a trader. And my least important goal is to make a lot of money. Some days I do make a lot of money, but I don't try hard to make a lot of money. What I try hard to do is make money, and sometimes I'm fortunate and I make a lot. I'm much more concerned about following my rules, doing the right thing, not making stupid mistakes. And if I do that, I will make money, and sometimes I'll make a lot of money. If I focus too much on making a lot of money, I'll end up losing money. So to me, the most important thing is try to stay objective and do the right thing, and that gives you your best chance of making money. If you want to make a lot of money, you're probably feeling greedy, and you're being influenced by emotion, and you'll have a hard time following your rules and achieving your goals. You'll end up losing. What's the big picture? In trading, it's actually fairly simple. You buy at support and you sell at resistance. If you're long, you wait for a rally up to a resistance level and you start to scale out of profits, and that creates a small pullback. If the market goes higher to another resistance level, you continue to sell out. If you're short and the market is going down, you're going to buy at a support level. And if you're flat and the market goes down to support, you look to buy. If you're flat and the market goes up to resistance, you look to sell. It's no secret. Just turn on television and look at Fast Money, Options Action, Money in Motion, Fox Business News, CNBC, and listen to traders. That's all they do all day long is talk about, the market is coming down to a support level, or a gap down, but it's right at a support level. I think I'll buy. Or, we had this big bear breakout and now we're rallying, but it's testing the breakout point. I think I'll sell. You don't hear them saying, there's a dark cloud cover or a morning star or a harami pattern. They're not talking about candle patterns. They're talking about support and resistance. Sometimes you'll also hear them talk about, the market is really strong. I'm going to buy, or I'm going to buy calls. The bull market, the market's racing up. So in other words, they see the market as in being in a bull breakout, and they buy. And they don't sell out at resistance because they assume resistance will fail. And they look for any reason to buy. They'll buy at the market. They'll buy a strong bear bar. They'll buy a strong bull bar. They don't care. They just know the market is going up and it probably will be higher, so they're going to buy. And in a strong bear breakout, they don't pay attention to candle patterns. They're going to sell because they know the market is going lower, or they feel strongly that it will, and they believe that all support will fail and that the market will just continue lower and lower and lower. And they'll look for any reason to get short, and you will never hear them, or only rarely ever hear them, talk about a candle pattern. So the context, where we are in the market cycle, the strength of the market, all the bars to the left, that's much more important than the candle patterns. Management is the key. You're buying at support, you're selling at resistance most of the time. During the strong breakout phases, which happen maybe 5% of the time, you're trying to get in the market immediately for any reason. If the risk is big, let's say the market's in a strong bull breakout and you see that the stop has to be far below where the market currently is, and you're afraid of taking a long, either you trade very, very small, or you use options. Options are an alternative to a very wide stop because your risk is contained. Also, sometimes you'll hear traders who are long on television and the market has gone a long way and the logical stop is far below, and they don't want to risk that much. So they'll replace their stock position with options. So they'll sell out of their stocks, take their profits, and then buy a call or buy a call spread because they don't want to risk to where they have to risk given how far away the logical stop is, let's say the most recent high or low. Beginners always want trading to be easy. Al, why can't you tell me what the perfect trade is? Why can't you tell me the perfect setup? I want to make money. I'm willing to work really hard. I'm willing to study. I deserve to make money. But it's not. What beginners fail to realize is that there are institutions on both sides of the market at all times. For you to be able to buy, an institution has to sell it to you. For you to be able to sell, an institution has to be able to buy the other side. And both the bull and bear institutions are profitable. And they're making. How can both make money if one side's buying and the other side's selling? There are lots of ways, but it all comes down to management. So, for example, if you're buying and a bear institution is selling, they might be willing to sell in more higher. They might be willing to scale in. They might be hedging and offsetting the position in another market. You just don't know. The bottom line is it's not going to be easy. Trading is always going to be hard because you're trying to take money from institutions, and the institutions are profitable, and there are institutions on both sides. So the margin is always going to be small. Beginners want an edge. They want to be able to buy at, some magical signal that's going to work all the time, or a very high percentage of the time, with very little risk. But if you think about it, if you're going to be able to buy with potential for a huge reward and very small risk and a high probability of success, there has to be an institution willing to take the opposite side of the trade. And the institution won't do it. And because there's no institution who will take the other side of your trade and willingly give you money, your perfect trade cannot exist. Also, traders feel like everything that they've done in life, if they work hard, they get paid. And if they work hard, they deserve to be paid here as well. Let's say they're a furniture maker and they make a chair, they get paid. If they make 10 chairs, they get paid 10 times much, 10 times as much for all their hard work. But that's not how the market is. You don't get paid simply because you work hard. So you can study all you want. You can learn candle patterns as much as you want. You can force yourself to be as disciplined as you want, but you don't deserve to get paid. It's like a 40-year-old baseball pitcher who made a fortune through his career, and now his 90-mile-an-hour fastball is down to 84 miles an hour, and batters just hit him like crazy. That 40-year-old pitcher can work as hard as he wants, but he's no longer going to get paid, because that's the nature of the business. And trading is the same way. You don't get paid for hard work. You get paid for being good. Life is not fair. You can look at people on television who appear to be rich. You can listen to people say Goldman Sachs makes a lot of money, or hedge funds make a lot of money, and therefore I deserve to make a lot of money. I'm a human being. I have the same basic human rights. I deserve to make money too, especially if I'm willing to work hard. But that is not true. You don't deserve anything in trading. Nobody does. And Goldman Sachs, they're as good as their last trade. If they start to lose, trade after trade after trade, they'll go out of business. Again, as I said, perfect trades do not exist. Beginners always want them. People are always asking me, Al, what's the best setup? There is no best setup. Look at the charts. The market is trading all day long, and that means institutions are buying and selling all day long. You make money by doing what they're doing. So you look to buy and you look to sell all day long. And you just try to find setups where there's an edge, where you have some advantage, where you can structure the trade and manage the trade in a way that will likely result in you being profitable. But even at your best, your edge is going to be small. So first of all, you have to get good enough so you have an edge, a mathematical advantage, a mathematical likelihood that if you do what you're doing 100 times, you'll end up with a profit. And your edge can come from taking low probability trades. So you can be right 40% of the time and lose 60% of the time and still make money if your system results in taking winners that are several times greater than your losers. Candlestick patterns, I think they're a fraud. I was looking at the internet the other day and Google searching how to trade to get ideas about what my competition is doing in terms of courses, and it looks like everyone is pushing candlestick patterns, and it's as if that's the way to make money, and it's not. Look at traders on television. When's the last time you heard a trader talk about a candlestick pattern? They don't talk about them. Goldman Sachs and hedge funds, they're not using candlestick patterns. High-frequency trading firms, they're using tick charts. They don't even see candlestick patterns. Candlestick patterns are being sold by false prophets as a means of taking you to trading heaven, and that's just not the case. They give you false hope, and that is not how traders make money. A setup is composed of two things: a candlestick pattern, in other words, a signal bar, or a signal collection of bars, and a context. Context is everything to the left, and that is far more important than the signal bar. For example, if the market's in an extremely strong bull trend, it doesn't matter what the candlestick pattern shows. You're going to buy. If it's a strong bear bar, you're going to buy. If it's a strong bull bar, you're going to buy. If it's a weak bull bar or weak bear bar, you're going to buy. The context overwhelms the candlestick pattern. On the other hand, if it's in a pretty strong bull trend and you're looking to sell, you only want to sell if you see a very strong bear reversal bar. Most of the time, starting out, you should not be giving any thought to selling in a strong bull trend or buying in a strong bear trend. You'll lose money. Trading, takes years to get good, and you will lose money for years. Most traders lose forever. However, we're all attracted by the lure of making a lot of money and being able to get a multiplier effect. When I was an eye surgeon, I could do one operation at a time. I could not do 10 or 100 at a time. As a trader, I can trade one contract, but I can also trade 10 contracts or 100 contracts. And everyone is intrigued and lured by the possibility of becoming rich. And that's why we're all here. It's fun, and the upside is huge, and we want to find out if we can do it. We know that people do it. Goldman Sachs, hedge funds, a lot of them are very rich, and that's why we're all here. We all are attracted to the possibility that we can figure it out well enough to become billionaires. And that's okay. But you have to remember that everyone loses for years, and that most traders who try this end up losing forever. And if you're looking for perfect trades and profits to take you to salvation, you will lose. The only way to win is by doing it yourself. Learning enough to do it. Learning some successful systems, and being disciplined and doing the right thing day after day. The market's in a never-ending cycle. It's either in a trend or a trading range. And when it's in a trend, it becomes a trading range. And when it's in a trading range, it becomes a trend. Trends happen in two ways. There's a spike phase, the breakout phase, the strong trend phase. That gives way to some two-sided trading, and then the market's clearly in a channel. The channel becomes increasingly two-sided, increasingly flat, and part of a trading range. And once it's in a trading range, it's in breakout mode, and it can break out in either direction, and then the process begins all over again with another trend breakout. You have to pay attention to the type of market that you have, where you are in the market cycle. So if you look at the chart and it's in a trend, you need to know whether it's a strong trend, in other words a breakout, or a weak trend, in other words a channel, and you trade them differently. And if it's not in a trend, then it's in a trading range, and that also has its own characteristics, and you trade it differently from how you trade a trend. So here's an example of the market cycle. The green boxes are trading ranges, and trading ranges can break out in either direction. For example, here's a trading range. In a bear trend, it broke to the downside, but the breakout failed and it reversed up. Here's a trading range in a bull trend, and it broke to the upside. Here's another trading range in a bull trend, and it broke to the downside. So trading ranges can break out in either direction, and when they do break out, they can sometimes reverse. The pink box, that's an example of a strong bull trend, a breakout phase. Right here, I don't have it in pink, but that's another example of a breakout phase. The red lines, they highlight the channel phase of a trend, where the markets become more two-sided. There's overlap. There's some bear bars in a bull trend, some pullbacks. And channels eventually evolve into trading ranges. Within a channel, there are pullbacks, which are very small trading ranges. On smaller time frame charts, that is a trading range. A pullback is simply a small trading range, but unlike other trading ranges where you don't know the direction of the breakout, a pullback occurs in a channel within a trend, and the odds are high that it will break out in the direction of a trend. All trends have some element of spike and channel to them. Here's the spike phase of the trend, and it's usually followed by the channel phase of a trend. And channels usually evolve into trading ranges. When you look at the entire screen, it's a trading range. But if you only look at the chart through bar 10, it's a trend. So yes, in the move from 5 to 10, it's in a bull channel and a bull trend. But later on, when you're over here at bar 18, you would say that the trading range began maybe at bar 4 or maybe at bar 5. So the move from 5 to 10 is a bull trend, it's a bull channel, but it's also part of a trading range. And after the market's been in a trading range for a while, it breaks out again into a trend. Each blue box is a breakout phase of a trend, and the space between the red lines is a channel phase of a trend. So you have a breakout and then a channel, a bear breakout and a bear channel, bull breakout and a bull channel. It's important to know where you are in the market cycle because each part of the cycle offers different trading opportunities. And if you know where you are in the cycle, you can fall back on trades that are appropriate for the current market condition, a breakout, a channel, or a trading range. New traders sometimes worry all day long about capturing the absolute best signal of the day. On the spider chart, there are 78 bars in the day, and sometimes the best signal occurs once on one of the 78 bars. And if you don't happen to be at your computer at that moment for any reason, or if you see it and you feel like you're pressured to make a decision whether or not to enter, and you choose not to enter, beginners sometimes feel bad that they missed the best setup. That was the opportunity where the reward was the greatest and the risk was the least and the probability was good, and they feel bad. But it does not matter, because as long as you understand what the market is doing, you can make profitable trades in any part of the market cycle. And I have modules about trading every part of the cycle. So for example, you can capture a reversal. If you don't capture the reversal trade, let's say a bottom, and the market starts to rally strongly, the market becomes always in long, it's in a breakout phase, then you can enter during the breakout phase. There are many good ways to enter during breakouts. Once the market starts having pullbacks, you can enter during the pullbacks. Once it starts to channel, you can enter during the channel. During the breakout phase, you go for swing trades. When it starts to channel, you can swing trade at first, but later in the channel, you go for scalps. When it enters a trading range phase, you start to buy low, sell high, and scalp, and then you wait for the next breakout. So you can trade at any part of the market cycle, and it does not matter if you miss the very first part of a new leg up or down, because you can enter at any point as long as you understand how to trade. I have modules that address trading at every part of the market cycle. Here's an example. So the spider 5-minute chart, the market gapped down and then it traded down a little bit. You could draw a trend line through here, a little bit of a breakout, did not reach the moving average, arguably a higher low major trend reversal. So here's the bear channel and the trend line break, about 5 to 10 bars sideways, and then 2 or 3 legs down, push down here, reversed up, more buying pressure, push down here, more buying pressure. So look what's happening after the bear bars. We tried to break to a new low, bull bar, 2-bar reversal. Tried to sell off, bull bar. Tried to sell off, bull bar. Tried to sell off, bull bar. Right? So the bears are obviously no longer able to generate consecutive trend bars as they were on the open. So the bears are clearly weakening, and we're transitioning into a two-sided market. Here you have a possibility of a breakout of the bear channel and a higher low major trend reversal and a very good looking signal bar, an IOI pattern with the bull bar closing near its high. You could also call it a head and shoulders top. So this technically or arguably is the best entry of the day. It could be the low of the day. We could be at the beginning of a bull trend. The setup is good, so the probability might be 55-60%, and the risk is small because the signal bar is small. So if you were who knows, on the phone with one of your kids and you did not take that trade, don't get depressed. By the time this bar forms, this big bull breakout bar, now we have 4 consecutive bull bars, a close above the trading range, a close above the moving average, and we have a higher low major trend reversal signal. Most traders at this point think the market is always in long. So what do? You go to the module on how to trade bull breakouts, strong bull trends, and it'll tell you. And one thing you can do is simply buy at the market. We have an II pause with a bull bar closing on its high tick. You can buy there. We have another breakout. We can buy here. You can buy anywhere in here. You could buy a high 2 buy, high 1, high 2. You could buy that. A larger two-legged move down, 1, 2, a bull inside bar. You can buy that. Follow through after the bull bar. You can buy above its high. Wedge top up here. 1 push up. Here's a bull spike. Second push, third push. You could, and a good-looking bear bar. You could sell that. The market's selling off for 3 bars, and the context is good for a pullback. We have a wedge top, so we should get 2 legs sideways to down. We have a good-looking bear bar closing on its low tick. We have 4 consecutive bear bars. Aggressive traders will place limit orders to sell above the high of the prior bar, looking for 2 legs down. Channel down, very, very tight. With dojis, to me this is probably the first of 2 legs down. The market went up, down, up, so there's a low 2 short, either below here or below this bar. And, I personally would not take it. I think the day's a trading range day, and we're getting low in the day. I would only look to buy. But, once in here, if you wanted, you could trade as a trading range. I think, in general, at the start of the day, it's better to wait for a swing setup. So it's probably better for most traders not to begin trading until this point. However, if you missed that great entry, there were many other opportunities to make money all the way up, and then you could make money on the way down as well. So it does not matter if you missed this. Yes, it probably was the single best trade of the day, but there were many other very good trades. And you can make a living looking for the best trade of the day, but if you understand the market cycle and where you are in the market cycle, there are many other opportunities to profit, and you don't need to capture the best one every day. I usually use binary decisions to decide. I'm always trying to make my decisions easier, and if I can structure the decision so that there are only 2 choices, then I have a binary decision, and it requires less thought. For example, is the market in a trend or a trading range? Here's an example. If the market's going up, is it going up in a bull trend, or is it going up in a bull leg within a trading range? And if I can clearly answer the question, I trade appropriately, either a trading range or a bull trend. If I cannot clearly answer the question, in this particular case, I assume it's a trading range. So if the market's going up and it's in a bull trend, I'm only looking to buy, and I'm going to try to swing at least part, maybe the entire position. If, on the other hand, I think the market's in a bull leg in a trading range, I'm only going to take buy signals, and I will consider strong sell signals near the top of the range, especially if they're second entry shorts, and I'll only scalp. I want to buy low, sell high, and scalp. So near the top of the range, I'm looking to sell, but I'm only scalping. And near the bottom of the range, I'm only looking to buy, and again, only scalping. So if the trend is a strong trend, if I look at it and say, wow, that's strong, then it's in the breakout phase. also the spike phase, and I know that I need to get long immediately. And if I don't see an easy signal to allow me to enter, I buy at least a small position at the market. Now, if the market's going up, a bull trend, the initial stop is below the bottom of the spike. So if I'm buying way up above the bottom of the spike, my stop is wide, so I have to trade small, at least initially. And then if I get a pullback or other signals, I can build my position as the market goes up. If I look at the trend and it doesn't look all that strong, then it's a weak bull trend, right? And a weak bull trend is a channel. If the channel is extremely tight with very little overlap and very few bear bars, then it's essentially a breakout, and it certainly is a breakout on a higher time frame chart. So I trade it like a strong bull trend, even though it's a channel. If it's a broad channel with big swings up and down, especially if it's very flat, and it's almost like a trading range that has a slight upward slope to it, I certainly take the buy signals because it's a channel and a bull, so it's a bull trend. But if the swings are big, I can sometimes take trades in both directions and trade it like I do a trading range: buy low, sell high, and scalp. If the market's going down, again, I try to structure a binary decision. Is it clearly in a bear trend, or is it probably in a bear leg in a trading range? If it's clearly a bear trend, I only want to sell, and I want to swing at least part of my position. On the other hand, if I think it's a bear leg in a trading range, I look to take sell signals for sure because it's a bear leg, and I'll take strong buy signals near the bottom, especially if they're second entry buy setups, and I'll only scalp. Bear leg in a trading range, if it looks like the market's in a trading range, in other words, if the market has been swinging up and down and the current leg seems to have weakness as it's forming, so as the market's going down, it has a bear bar and then a bull bar, a bear bar and a bull bar, a bear bar and a bull bar. So if there's a lot of buying pressure in the leg as the leg is going down, and the leg is still within the bars to the left on the chart, it's more likely a bear leg in a trading range rather than a bear leg in a strong bear trend. Okay, if I look at the bear trend and it looks strong, it's in the breakout phase, it's spike phase. Breakout, spike, same thing. I need to get short immediately. I either sell at the market or I wait for a bear bar to close near its low, and I sell that bar. And in any case, I want to get short at least part, because if I wait for a pullback, the market may drop 5 or 6 bars and go way down before there's ever a pullback, and I don't want to miss the entire trend. Since my stop goes above the top of the bear spike, which can be far away, my initial entry will be small. Once I decide it's in a bear trend, I need to know if it's in a weak bear trend. In other words, is there a lot of two-sided trading and some buying pressure? If it is, then it's in a channel. If the channel is very tight with no bull bars and no pullbacks or only minimal pullbacks, then I trade it like a breakout, like a strong bear trend, and I only look to sell. On the other hand, if it's going down with swings up and down, and it's almost like a trading range that has a slight downward slope to it, I'll trade it like a trading range and take trades in both directions: buy low, sell high, and scalp. But since it's a trend, lower highs and lower lows, I want to make sure that I take the sell signals. The buy signals are optional, and I only take them if the setup is strong. Who's in control of the market at any given time? If you look at the market and you had to get in the market, either long or short, if someone said you have to do it, you have to buy or you have to sell, whichever trade you make is the always in direction, always in long or always in short. And if the answer is clear, then you only want to take trades in the direction of the always in condition. So if you look at the market and say, yeah, if I had to be in the market, I definitely would be long, then only take buy signals. Okay? And one way to tell who's in control is to learn how to spot buying and selling pressure. I have a module earlier on that talks about the footprints of buying pressure and selling pressure. And that's the single easiest way to tell if the market's always in long or short. If there's much more buying pressure, it's always in long, and it probably will go higher. If there's a lot of selling pressure, it's always in short, and the market probably will fall. Perfect trades, okay, they cannot exist. The market lives in the band of 40 to 60% probability. Nothing is more than 60% certain. Nothing is less than 40% certain, because beyond that band, there won't be anyone to take the other side of the trade. Remember, you have to have institutions taking both sides of the trade, and because the institutions are all, basically, you have to assume they're all profitable, the margin, the band is going to be tight. Probabilities cannot get too extreme one way or the other. Beginners are always looking for guarantees and perfect trades. Tell me a signal that works all the time or 90% of the time. I don't want to lose money. You got to tell me something that works. And if you don't do that, what good are you? That's not the way the world works. The institutions control the market, and the bears and bulls both make money. And for that to happen, the edge for both sides has to always be small, and the probability has to be in a very small band. And the result is perfect trades cannot exist. You're living in a world of uncertainty. A lot of times it's hard to tell where you are in that 40 to 60% band. And that's just the nature of trading. You're never going to be certain about anything. However, if you can make the math work out, then you can still take trades. Even if you're only 40 to 50% certain that a trade is good, you can still make money based on the trader's equation if you go for a reward that's at least twice as big as your risk. So only 40% chance of being successful. If you go for a reward twice your risk, you're going to make money. If you want to scalp and take a small profit, you need at least a 60% probability of being successful. So, for example, if you're in a strong bull spike, you see how far away your stop has to be. If you go for a reward equal to the size of that stop, 60% trade, you will make money, even though your reward is only as big as your stop and not 2 times or 3 times bigger than your stop. Beginners are always waiting for the perfect setup. So they wait until they're very confident of the trend. So they see a big bull bar, another big bull bar, another big bull bar, and they say, yeah, it's going up. And then another big bull bar, and then a smaller bull bar, a smaller bull bar, and another big bull bar. And they're saying, yeah, it's definitely going up. I know it's going up, and I don't want to risk all the way to the bottom of the spike, or even halfway to the bottom of the spike. That's just too much risk. I'm going to wait for a pullback. So they end up missing the entire breakout phase of the trend when the market runs many, many points in a very limited period of time, and then the market suddenly starts to pull back. And they look at the pullback and they say, wow, that's a buy climax. I think the market's going to reverse and fall very, very far. So as the market's pulling back, they'll get a high 1 buy setup. They don't take it. The market goes up. They get a high 2 buy setup. Oh, this time it's going to reverse for sure. And they don't take it, and the market goes up. So they end up missing the trend, the spike phase. They end up missing the channel phase and the pullbacks along the way. And they end up missing the entire trend. Very often, by the time the beginners see the market as being in a trend, the stop is very far away. That's okay. You just determine the size that you would have to have for your stop. So if you normally use a 2-point stop, and now the stop has to be 5 points away, for example, the bottom of a very strong bull spike, just reduce your position size. Take a 1/3 size position. And mathematically, that is a very good thing to do. You have to get market when it's in a strong trend, even if you're trading very small. And you can always build your position to a full size later on. So let's say you're shorting in a very strong bear spike. You sell at the market, and you hold short, and then you're trading small, and then the market starts to pull back, but you're confident it's going to go lower. You continue to hold your swing portion, and then you can add a scalp portion in as well. And then on the move down, you can scalp out the scalp portion, but continue to hold your swing. Being patient has 2 parts to it. One is being patient while you wait for a good setup, and the other is being patient when you're in a good trade and make sure that you hold it for enough of a reward. Don't scalp out early. It's hard to hold as the trend constantly tries to reverse. All trends are always trying to reverse. But you have to learn to rely on your stop and on your read. When you look at the chart, even though it's starting to channel up, it's still a trend. Learn to rely on your stop. Put it below the most recent high or low and just hold until the market appears to be transitioning into a trading range. So don't scalp when you should be swinging. So when there's clearly a trend, make sure to swing at least part. The profits in a trend end up being much larger than what seems possible at the time that you put the trade on. Remember the trader's equation. You only take a trade if the probability of success times the reward is greater than the probability of failure times the risk. And the probabilities are always between 40 and 60%. And at least that's the assumption you should make. The reward, that's where you set your profit target, so you always know the reward. The risk, that's how far away you put your stop. You always know the risk. What you don't know is the probability. And if you look at the market and you say, yeah, it's probably good, assume the probability is 60%. If you look at it and you say, I don't think this is going to work, assume the probability is 40%. And if it's 40%, you have to go for a reward that's at least twice your risk. So you know your risk, you know where your stop has to be. If you think the trade doesn't look all that good, assume 40% probability. Then you have to go for a reward that's at least twice as big as your risk. So just place your profit-taking limit order 2 times the number of ticks away from your entry price, as is your stop. Probability is the most important variable in the trader's equation because it's the only one that you cannot control. You determine the risk, you determine the reward. The probability you don't know. Probability is the reason why it's so hard to make money, but management is the key to success. Probability, the uncertainty inherent in all trading, it makes beginners not take potentially great trades, and it makes them exit strong trades way too early. They're so happy to finally have a profit that they just grab it, and they end up leaving a much larger profit on the table. Probability is the source of all emotion. There's no emotion to setting your stop. You just look at it, you know where it is. There's no emotion setting your profit-taking limit order. It's either 1 or 2 times your stop distance or a swing, and you just let it go. The only reason people have emotion in trading is because of probability. Computers, they don't have emotion. And you can only make money if you follow what the computers are doing. So if you're making judgments based upon emotion, you're not following what the computers are doing, and you will lose money. So emotion creates losers, and you'll lose until you learn how to be free of your emotion, and you cannot win until you're comfortable with constant uncertainty. You're always going to be uncertain, and that's just the nature of the market. There has to be someone, an institution, taking the opposite side of your trade, and they would not do it if they were certainly going to lose. So you're always going to be placing trades when you feel the probability is never as good as you want it to be. I mentioned this before. Traders swim in a sea of constant uncertainty. In clarity, it exists only briefly during strong breakouts. Most of the time, trading is unclear, and rarely is it more than 60% certain. So if you're going to be a trader, these are realities that you have to accept because they're real. I mean, this is our life. Beginners always want perfect trades, but they simply can't exist. You just have to accept that you'll be wrong 40 to 60% of the time, and you'll be right 40 to 60% of the time. And if you manage your trades properly, setting your reward and your risk correctly, you can make money doing this. You have to remember the 60-40 rule. That is that most of the time the probability is between 60% and 40% that you can make a profit by either taking a long entry or by taking a short entry. And remember, if you buy, there's an institution on the other side selling, and that institution is profitable, and selling at this moment is part of their profitable strategy. If you're doing the opposite, if you're selling, there's an institution taking the opposite side of your trade that's buying, and their buying is part of a profitable strategy. So most of the time, it doesn't matter which side you pick. If the market is falling sharply, you can sell, betting it will fall more. You can buy, betting it will reverse. and it doesn't really matter. The key is trade management. Sometimes during strong breakouts, you should only be going in the direction of a breakout. Whenever there's a strong bull breakout, you should only buy, and you have to buy. Find any reason to buy. I have a module on bull breakouts that talk about the reasons. If it's in a strong bear breakout, you have to sell. If it's in a channel, let's say a bull channel, and this channel is very strong, only look to buy. Once the channel starts to weaken and get strong sell-offs along the way, you can start trading in both directions. But most of the time, you can make a case for the bulls and a case for the bears, and it's far more important how you manage the trade than it is which side you can take, which side you take. Very often, taking the 40% side is a better bet than taking the 60% side. So, for example, if the market is forming a lower high major trend reversal, the probability may only be 40% that the trade will work, and it may be 60% chance that the trade will go higher. But if the context is right, the 60% chance may be simply for a reward equal to the risk and not be very big, and the 40% may be for a reward many times greater than the risk and have a much stronger trader's equation. Let me give you an example. This slide is from the module on trading a weak bear channel, and the market is starting to form lower highs and lower lows. So it's in a bear channel. And then here, on pretty much a double bottom and a very strong bull rally. At the close of this bar, bulls will say, wow, 4 bars up, 2 of them have very big bodies. I think there'll be buyers below, and the market will continue much higher. The bears will look at the close of this bar and say, wow, what a gift. The market's making lower highs and lower lows. I like the probability of the market continuing to do so, so I'm just going to sell here at the market at this close. The bulls are buying this close, looking at it as a strong bull spike, and they're betting on the successful breakout. The bears will look at this close and say, this is great. What an opportunity to sell at an extremely high price. My risk is only to above the most recent lower high, so I'm not risking much for my entry price to the prior lower high, and my reward is at least to a new low, because if this is a bear trend that will continue, it'll form a series of lower highs and lower lows. So at any given moment, even when you see something that appears to be as strong as this is, there are bears who will sell aggressively. Likewise, the bulls will see this strength and they'll buy aggressively. In this particular case, the market continued way down and the bears won. But there may have been a 50-50 chance that the bulls could have won, in which case the bulls would have made at least 2 times their risk. Whenever the market is 50-50, you should be going for a reward twice the size of your risk, and both the bulls and the bears will do that. The bulls who bought here, their stop might be below here, might be below this bottom of the bull spike. In any case, wherever it is, they'll go for 2 times their reward. If the market starts to turn up here, they'll do their 2 times calculation based upon actual risk, their entry price, to 1 tick below the low of the pullback. So just be aware that as certain as you are of anything at any given moment, you have to remember that there are institutions who are taking the opposite side of your trade, and they have at least a 40% chance of being right. So you should always be considering both sides of a trade. For example, Nike recently had a very big gap down on earnings, and if you listen to Fast Money, they were talking about, well, should we buy this or should we sell this? And as a beginner, you might think, wait a minute, how can they be thinking about buying and thinking about selling? That doesn't make sense. It does make sense, because if it gaps down to a magnet area, like a support area, it's a good area to buy. And if you manage your trade correctly, you can have a positive trader's equation and make money. On the other hand, the bears will argue, wow, that's a very big gap down. It probably will have good follow-through, and we'll make several times more than we stand to lose if we're wrong. And it doesn't matter what the candle pattern is. What is far more important all the time is the overall, the big picture, the context. You know, are you at support Are you at resistance? Are there multiple levels of support? Are there multiple levels of resistance? Does the resistance appear very, very strong? Does the support appear very, very strong? Is there a good target? If you, let's say you take the short, is there a reasonable target that is going to pull the market down? In other words, is there a support level way below the market that might pull the trade down there so that your risk is much smaller than your reward? Likewise with the bulls. Do they have some kind of target way up here? Maybe a trend channel line drawn across these bars would project way up here. So they may be holding for a reward many times their risk. So, just be aware that at any given moment, bulls and bears are entering, and they're very smart. They're institutional. And even though it may look extremely unlikely, it's much more likely than you think. And assume 95% of the time that the probability for the bulls and for the bears is within 40 to 60%. You cannot control the probability. You're either confident, certain that the trade looks good, then assume the probability is 60%. Or you're unsure, I don't know if this looks good, then it's 50%. Or if you think, well, this probably won't work, but the reward is so much bigger than the risk, I'm going to take the trade. Then the probability is 40%. And just make a reward sufficiently bigger than the risk to turn the trader's equation positive. In general, even with a 40% probability, as long as your reward is twice your risk, you have a positive trader's equation. Again, the risk is the number of ticks to your stop. The reward is the number of ticks to your profit target. And when you're not certain, you need to set your profit target at least twice as far from your entry price as is your stop. You need a reward twice as big as your risk. You really have to learn how to manage trades well, and it's more important than spotting perfect setups. Most of the time, there's a profitable way to manage both a long and a short trade. Remember, if you buy, that means some institution sold it to you, and that institution has a way to make a profit. Otherwise, they would not sell you the other side of the trade. If you sell, that means an institution had to buy from you, and they would not be buying unless they could make money by doing it. So most of the time, there's a way to make money by either being short or being long, depending if you manage the trade correctly. An obvious way is scaling in as the trade goes against you. That's beyond, I think, the reach of most beginners. So what kind of chart should I be using? Price action techniques work on all types of charts because the movement on charts is simply a reflection of human behavior, and any chart captures that behavior. For most traders, a good starting point is a 5-minute chart, or maybe even a 15-minute chart, assuming they can trade small enough so that the increased stop size does not cause them to put too much money at risk. My rule of thumb for somebody starting out, in fact for anyone, even very experienced traders, is to avoid any chart with more than 20 bars per hour. So that would be a 3-minute chart. Most traders should not be even trading a 3-minute chart. And they certainly should not be trading a 20-tick chart or a 500 share chart or a 1-minute chart or 2-minute chart. Why not use a small time frame? High-frequency trading computers use the smallest time frames. They use tick charts, and many of them make a lot of money. The risk is obviously very small, and if you have a winning system, why not use it 10 to 20 times a day or 50 times a day instead of just 3 or 4 or 5 times a day? You can do manual high-frequency trading. Paul Rotter does hundreds of trades an hour by hand. And there are some day trading websites that recommend trading on a 1-minute chart or a 20-tick chart in crude oil or in the currencies. This is simply manual high-frequency trading, and if your techniques are good, you can make a fortune, and that is absolutely correct. However, there's a problem. 99% of great traders cannot make money using them year after year. And if you try, your account will slowly or quickly disappear. And why is that? Why not trade on one minute chart? What's the problem with a 1-minute chart? the risk is very small, and that's very appealing to beginners because their accounts are small, and the one thing they're most concerned about is risk. And if they trade a 1-minute chart, the stop is closer to their entry price, and their risk is less. And the logic is great. If you have a winning system, why not apply it 20 times, 50 times a day, 100 times a day? You'll make that much more money. Time is the problem. Deciding to take a trade takes time. Deciding how to manage your trade takes time. And our brains are not designed to make that many decisions correctly in so little time, and to make them so many times a day. I'm a very smart guy, and years ago I could trade the 1 and 2 minute chart, but it was very hard, plus it was not fun, and I was not making any more money than when I trade the 5-minute chart, because it's really hard to do. You end up cherry picking, especially after an hour or two of trading. You get tired, you lose focus, and invariably once you start to cherry pick, you'll find that you tend to pick all the bad cherries. They look great, but they tend to end up being the worst ones. The way the market is structured, it's always going to generate the most pain. So the trades that look the easiest usually are losers. And it's very hard to make the decision when you have very little time. And so if you're trading a 1-minute chart, you're giving yourself seconds by the time the bar closes to make a decision whether or not to take the trade. And it's simply not possible for 99% of successful traders to do it well, day after day, year after year. So those websites that promote that kind of trading, it sounds great, little risk, big profit. The reality is very few traders can do it successfully, for a career. We're not talking about doing it successfully for a few days or a week or even a month. We're talking about doing it for 10 years, 20 years, 30 years. And I think most traders simply cannot do that, and it's not worth it, because you can make a lot of money doing something else, and you'll enjoy what you're doing much more. What's the alternative? Well, before trying a 1-minute chart, first prove that you can be consistently profitable on a 5-minute chart. And if you can, simply work on increasing your volume, the position size. And in the end, you'll make far more money than by reducing your time frame and increasing the number of trades. Taking 5 to 10 trades a day on a 5-minute chart for most people is going to be vastly much more profitable than taking 20 or 30 trades a day on a 1-minute chart. In fact, you will lose money if you try trading 1-minute charts. Okay, where do you begin? Any trade with a positive trader's equation is a good trade. It does not matter where you are in the market cycle. Some traders prefer to trade only certain types of setups, and that's okay. If they're trading trades with positive trader's equations, they'll make money. The best place to start probably is with major trend reversals. Okay, the setup, the probability is usually between 40 and 50%. Make sure to set your reward to at least twice as big as your risk. This results in a good trader's equation, and an important factor is time. There's usually enough time to decide, and that's very important for beginners. When you enter a trade, if the goals are really not all that clear, rely on defaults. For example, you'll put an initial risk beyond the signal bar. For example, if you're buying, you put your stop below the signal bar, 1 tick below, and you take partial or full profits at twice your initial risk. And if you took partial profits, you swing the balance. In terms of scaling out, if you are trading a big enough position that would allow you to scale out, you might take half off once the profit reaches twice your initial risk, take another 25% off at 3 times your initial risk, and then swing the balance and trail the protective stop and look to exit before the end of the day if it's a day trade. Once the trade goes your way, you should look to adjust your profit targets based upon your actual risk instead of on your initial risk. So you would take half off at 2 times your actual risk, take another 25% off at 3 times your actual risk, and swing the final 25%. Once the trade goes your way, you should look to adjust your profit targets based upon your actual risk instead of on your initial risk. So you would take half off at 2 times your actual risk, take another 25% off at 3 times your actual risk, and swing the final 25%. Here's an example. We have a bear trend, a bear channel. I didn't draw the channel line in. A break of the trend line, a test of the moving average, pretty good buying pressure in the rally, and then a plunge down that immediately reversed up. You could buy above this bull bar, or you could take the second entry above this bear bar for a double bottom bull flag, or you can say it's a higher low major trend reversal where the higher low came in the form of a double bottom. It's also a triangle, 3 pushes down, 1, 2, 3. In any case, the protective stop would go below the bottom of the higher low, the big bull trend bar, and you'd go for a reward that's equal to at least twice your risk. You can just walk away if you want. Just place the orders and take a walk and come back in an hour. You know, if you can't stand watching. If you don't take the first entry, then you can always wait for the always in condition to become clear. And the always in becomes clear by either of 2 things. Either there's a strong breakout that immediately tells you the market's clearly always in long, or you have a series of consecutive trend bars. In that particular example I just showed you, if you start getting 3, 4, 5, 6 consecutive bull trend bars, traders will believe that the market's going higher, and that means they believe the always in condition is long. And therefore, if you buy anywhere as that spike is forming and put a stop below the spike, you have a 60% chance of making a reward that's at least as big as your risk. So here's that same chart. Doesn't matter. Let's say you did not buy here and you did not buy here, and you see it's a potential higher low major trend reversal, and now we have 4 consecutive bull bars. And not only 4 consecutive bull bars, there's good buying pressure. The close of this bar is above the high of this bar. The low of the following bar is above the high of that bar, so we have a gap. Same thing here, another gap here. This low, that high, another gap. A good sign of buying pressure. So if you did not buy here or here, you could simply buy at the market, here or as this bar is forming or at the close of the bar, and put a stop below the bottom of the spike. Since you look at this and you say, yeah, it's going up, assume your probability is 60%. You therefore only need to go for a reward equal to your risk. The risk is below the bottom of the bull spike, so your stop is here. Your entry, let's say, is here. As a minimum target, you need a reward equal to your risk when the probability is 60%. So you'd look to take profits right here. And if you're afraid that the stop size is too big, just trade small. Okay? Trade half size, trade quarter size. It doesn't matter. Make sure to get some position on and use the correct stop even though it's wide. After the trend begins, you can look for pullbacks. If you're flat because you never entered, or if you're flat because you took profits, now look to enter on pullbacks. The market might be entering the channel phase of the trend. If the trend looks strong, go for a swing. If it looks weak and it looks like it's turning into a broad channel trend, go for scalps. Okay, so now we got that strong bull spike. We have a fairly deep pullback. It's 3 legs down, 1, 2, 3. You can call it a high 2. You can just say, well, it traded above here, traded above here. You have a 2-bar reversal at the moving average. Tail on top, not ideal, but it's always in long. And we have either a wedge bull flag to the moving average or a high 2 to the moving average. And we have a bull signal bar. So at a minimum, that's good for a scalp. Since the market's always in long, you can always take any position for a swing if you just use the swing stop. If you're going for a scalp, you don't want to allow pullbacks, so you'd probably put the stop below the bottom of the signal bar. The signal bar is a 2-bar reversal, so the stop would go below the lower of the 2 bars. In general, for a scalp, you're just looking for 1 push up, and you don't want to allow pullbacks. For a swing, you're expecting 2 or 3 or more legs up, and that means you do allow pullbacks. Once the trend starts to weaken, it evolves into a trading range. And when it's in the trading range phase, you buy low, you sell high, and you scalp. Eventually, there'll be a new breakout, either up or down, and then you repeat the entire process. So here's our higher low major trend reversal, and we're going up and we're getting near the high of the day. The market gapped down from this price area on the open today. It sold off from this price area 4 bars, 5 bars into the day, and we're back into this price area again, and now we have a bear reversal bar, and it's following a high 2 buy signal. A high 2 buy signal is often the end of the trend. I don't have a trend channel line drawn in here, but this is near the top of the channel. It may be an overshoot and a reversal. It's a good location for exiting some or all of the longs, and it's probably an okay scalp for a test down to the moving average. The last pullback reached the moving average down here, so this one probably will be at least as deep as the prior ones. Pullbacks tend to get bigger as trends go on. So if you take this for a short, I would only scalp it because it's not a major trend reversal, so the market's still always in long. And if you're going to short in a bull trend, you can only go for scalps. So you'd short it, sell below this bar, get filled over here, stop above there, and go for a risk at least equal to your reward. I think the probability of this scalp is 60%. I think it's a pretty good scalp. Which type of entry is best? It doesn't matter. Okay, they all can have positive traders equations, and you can begin trading at any point in the market cycle. The trading range, the strong breakout, and the channel. It doesn't matter. There are profitable ways to trade any part of the cycle. When traders are starting out, they should be looking to swing and either taking their entire position off once their profit goal has been reached, or with experience they can maybe take half off at their first goal, which should be at least 2 times the risk, and then take out maybe another quarter at another 100% times the risk, and then let the final piece go until the end of the day. Let me give an example. Let's say the spider is in a bull trend, and let's say your usual maximum size is 300 shares. So in general, you want the scalp size to be bigger than the swing size. So the swing size might be 100 shares and the scalp size 200 shares. And the reason for that is when you're swinging, the stop often gets far away. It's often far away when you first put the trade on. In general, when you're scalping, the stop is smaller, so you can trade so you can trade larger. So in general, when traders scalp, they scalp for more shares, a larger position, than when they swing. That's not always the case, but let me just use this as an example. A trade where you're comfortable trading 300 shares and you're going to swing 100 shares and you're going to scalp the other 200. In this particular case, we have a double bottom bull flag, or a gap up and a double bottom bull flag, a very strong signal bar. So let's say you bought 1 tick above the high of the strong bull reversal bar. You would be filled right here, and you put on your usual position, 300 shares, and you're putting it on with the intention of letting 100 shares swing until there's no more reason to hold it, until there's an opposite signal, or until the end of the day, or until the market flips to always in short. And the 200 shares you're planning on scalping out once you've reached a profit objective. Since the trend is pretty strong, you want your profit objective to be at least 2 times the risk. I would manage them. This is with experience. An experienced trader, this is how a lot of experienced traders view the market. They look to take partial profits, but if they get another signal, they'll put the scalp back on. So here's an example. Let's look at the swing side first. So if you bought your 300 shares down here, let's forget about the scalp part for the time being. You would be holding your swing part until we had the wedge top, and then we had a lower high major trend reversal setting up for a second leg down and a strong bear reversal bar, and it's right before the close. You want to get up before the close regardless, and this is a sell signal, a lower high major trend reversal after a wedge top. You should get a second leg down right before the close. So most traders would get out right here for their swing. So you bought here, you sold here, and you made 99 cents on 100 shares. So now I'm going to talk about the scalp portion. So the scalp portion, back here you bought your 300 shares, you planned on swinging 100, and at the end of the day you discovered that you get out over here with 99 cents. The scalp portion, you see a very strong trend. The market is trying to accelerate upward. If you did not have time to adjust your profit target to put it higher up, maybe you'd have it at 2 times your initial risk. You would have taken off either your entire scalp here, 200 shares, for 38 cents, or maybe you would have taken half of it off, maybe 100 shares for 38 cents. If you took half off, you might take the other half off here. Buy climax, bear, inside bar, possible final flag, maybe a bigger pullback. So let's say, for argument's sake, that you took 100 shares off here at 2 times your initial risk, and the other 100 here as the market was attempting to reverse. You're still holding your 100 shares for your swing. So by right now, you just have your 100 shares for your swing. Your stop might be below the last recent bull bar, maybe below the most recent higher low, but this is a pretty minor higher low. But either one of those would make sense. So you exited out your scalp. You still have your 100 shares for your swing. Experienced traders tend to view things as 2 separate trades, the swing and the scalp. Now they got a high 2 buy, a bull inside bar for their signal bar. Many traders would put their scalp portion back on, so they'd buy back 200 shares. So now they're back up to 300 shares, which was their original position. So they're still holding their scalp, their 100 shares for their swing, and now they've added 200 shares for their scalp, and they're looking for reasons to take profit, maybe 2 times the risk. Here, that would be 18 cents. A lot of traders, if it's close to a round number, 20 cents is a popular scalp target in the spider, they would round up and try to get out at 20 cents. So they would exit their 200 shares at 20 cents and then be back to owning only 100 shares, their swing portion. And then they would look for another buy, and they might buy here. After this, they probably would stop buying for scalps because the probability is too low. And when you're scalping, you need a high probability. Whenever you're taking a scalp, you're only taking high probability setups. And if there were other good buy signals, they'd buy them and they'd scalp out. They'd buy, scalp out, buy, scalp out, and they'd continue to hold their swing. And again, the scalp signals have to be good, which means high probability. And this is the end of the module on how to trade.